Welcome to the Dividend Talk podcast, episode 235. European dividend stocks are on fire. Hey, European DJ. I was going to ask you how your party was, but I know that you were not consuming alcohol. I was actually more concerned about which brewery you were supporting. Was it Diageo? Was it Pernod Ricard? Was it Coca-Cola now that you were on soft drinks? Who are you supporting? That was going to be my main question. But how was your weekend?
Well, my weekend is still starting, right? But no, I had a very busy week at work, very busy week. And oh my God, next week will be similar. But you know, keeps me busy, let's say. No, I had a nice party yesterday. It was good. But as you can hear, my voice is a bit poor because I'm suffering from a throat ache already the whole week. So, you know, I hope I'll get through this podcast without losing my voice, because this morning when I woke up, I was talking like this. So I'm already happy that I have a voice there.
Yeah, I was convinced it was because of alcohol related, but no, it wasn't. It's the result of poor voice all week. But look, we'll try.
Well, I should have drunk some vodka because I think it repairs the throat. Yeah, it nice cleans it, I think, and maybe I should do that tonight.
Yeah, do. Or even some whiskey, Jameson whiskey. A nice
no, I can't stand whiskey.
a nice Pernod Ricard whiskey, and really help those shareholders out. But hey, let's jump on to some of the news of the week. And we got a question from JC around the latest news on UNH, so United Healthcare. These guys can't seem to catch a break. But what I believe the news is around, because the share price dropped, is that there were some journalists that did an investigation on them, and it looks like they may have defrauded some of their customers, overcharged them for some of their products. Now, the company has said they're unaware of this investigation, they're unaware that this has even happened, but federal officials are now looking into it. The problem, I think, here is that journalists are not going to write that without any sort of proof. I don't think they will. There'll be some sort of integrity. Otherwise, they would get sued, particularly in America, where you can sue everyone for anything. So there must be some truth behind that. The problem, I think, for investors is that at the moment, there's a lot of bad news around UNH anyway, but at the moment, it creates this kind of unknown entity, doesn't it? You don't know if it's true. You don't know if it's not true. If it's not true, great. The share price will probably come back up. But if it is true, I mean, there's over 65 million people affected by this. That's probably going to be a lot of money they'll have to pay out.
Oh my God, yeah.
So, I mean, I don't know if it's true or not true. It's still too early to say, but it's just that uncertainty around this.
Yeah. Well, you know, and they reap in a lot of billions each year, right? Sometimes when I talk to Americans, knowing that they pay several thousands of dollars on healthcare.
Yes.
Then, poof. Yeah, you know, it's always tricky. But I don't own it, so I really don't have a feeling for it. How about you?
I don't own it either, but I suppose JC asked the question, would you be concerned if you held a stock? And I would be. I definitely would be. And like we know what happened a few months ago with the ex-CEO.
Mm.
So there's a lot of negativity around this company. Anyway, there's probably a lot of hate in America for this type of company. So I would 100%, especially as European and not understanding that kind of landscape, I would be definitely concerned.
But would you take profits then if you had profits in it? Would you be, because being concerned is one, right?
Yeah.
But the companies sometimes just go through some bad news cycles, and then in the end, those were really good buying opportunities. So how do you make decisions then around this? Because I think there's also the question about it, and we don't give financial advice here, and that's but can you explain your thinking process of what you would do in such situation?
It would definitely depend on the type of company. When you look at insurance and you look at the amount of people that this will affect, I think there would be no smoke without fire in something like this. And I would much rather get out now and sleep well at night and be safe with this type of company. Obviously, there's different types of litigations. And if you're looking at, I don't know, say Siemens, and they had some sort of patent infringement, but again, this was unknown.
Yeah.
I wouldn't be so hesitant to jump out of that. So it's case by case for me personally, but I think with a company of like United Healthcare, given their track record, given their past and the uncertainty around them, this additional bad news, if it does go to the courts, I mean, we've seen what happened with 3M. That price could jump off a cliff.
Yeah.
So I would much rather sleep well at night.
But then you have a case of NN Group and ASR that had these usury policies, from the late 90s to early 2000s, and there was also this huge share price drop. And actually, I decided to buy more during that time because I did the basic math, and I thought like, okay, if this is the case, then there's the potential litigation and no issue.
Yeah, but that wasn't old news. That was known for many, many years, particularly with ASR, and so we knew that was upcoming, and they had the cash flow behind it.
Yeah, and that's why, because you could have bought NN Group when they those years before for 25 or 30 euros. Yeah, and still you were then still the share price was going up with them, but then temporarily when this settlement and such became much stronger, it went down.
Yeah.
So I mean, if this news was always known, then you could argue it was priced in already, and investors continue to invest in it.
Yeah, exactly. But it was more of a known entity in terms of they knew ballpark how much they had to pay, how much cash they needed. They were increasing their dividends nearly double digits at that time because they knew they had the cash reserves to pay this. At the moment with this, it's unknown. So until you have the facts, it's harder to make a rational decision. Whereas if you sold them and maybe not made a loss, and it turns out that there is some litigation, but they have the cash and they're able to sustain the business, you might be able to buy back in at a lower price. But I think it's just the unknown, and also the fact that they're based in America, which I struggle with this type of industry because it's so different to Europeans. It wouldn't help me sleep well, I would say.
So I really couldn't tell you what I would do in that case, because in the end, they opened up a civil fraud investigation, federal officials. But this happens from time to time. And also journalists, I mean, there are reports sometimes, and we have an information disadvantage. But if I would sell every time on such news, I would probably end up selling most of my stocks in my portfolio over the course of the next 10 years, because there's usually something somewhere, even in well-run companies. So I understand the potential significance for this, but I guess it all then comes down to litigation, because in 3M, the PFAS, for me, that was like quite clear. We saw already the court verdicts coming in, and we know there's no limit to how huge those fines could be. So for me, this with UNH is so early, and that there's not really meat on it. But then already, would you sell them straight away on the first news that comes in?
No,
I know some people do that. That's why the share price is down. But that's also so hard. And I think this is the hard part. And I guess it comes down in the end to conviction. Having followed the company many years, you kind of should have a feeling for management and the risk in the business.
Exactly.
If you don't have that conviction, maybe you shouldn't have owned that stock in the first place.
Yeah, but it could be a small part of your portfolio that you own because the dividend yield is quite high, and you're aware of that. And in that scenario, you have this potential risk. There's no point in owning them. But if they're a top 3, top 4, top 5 position in your portfolio, well, then you should understand the risks. And if you get something like this into the equation, you shouldn't sell, because if you did, then your whole business thesis was wrong in the first place. So I think it's company dependent. But personally, when it comes to America and insurance, even healthcare, it's so difficult. So as a European, I'd be concerned.
For me as well. That's why I'm not invested in that directly. Good. Hey, let me then bring up another topic which really triggered me this week. The Dutch pension fund, ABP, the largest one in the Netherlands, known for providing pensions to, let's say, I think civil workers and teachers. They will no longer invest in stocks like Tesla, Meta, and Alphabet. I mean,
why?
You need to. According to the chairman, Harman van Wijnen, the 3 American companies no longer fit the fund's investment strategy. According to the strategy, the pension funds looks more at criteria for responsible entrepreneurship, such as policy on climate, biodiversity, human rights, and good governance. And according to the fund, this allows it to better assess the risks in the long term. Now, what you need to know, on my blog, right, EuropeanDJI.com, I've got my story. I have a picture there, I believe,
Yes.
of the last decade of re-indexing. People in that pension fund lost 20% purchasing power over the last decade. So my issue with this is, I've been thinking a lot about it this week, actually. The issue with this is like, you've got here a pension fund pushed by activists, probably like still even a majority of the fund holder, pension funds are supportive to this, because a certain type of people that works in the government and is teaching are supportive to this. They have no, I think they are not, they do this, and then at the same time they're complaining that their pension funds are not growing. Let's say that they are of our generation, somewhere mid-30s, early 40s. Yeah, and they still have 25 years to go. They still lose another 40% of purchasing power. And then they have a sandwich without their beloved cheese when they retire.
Yeah.
What do you think will happen? Those people will start massively voting for politicians that will tax the rich, because it's not fair that the rich have earned so much money in the stock market, and it's not fair because they didn't have that chance or something like that. Yeah, they will call it greed and everything, and this is like, it's insane. It's insane. And I tell you something else. Probably the majority of those civil servants are using Google.com to search for information, to check on things. They are probably using Google Chrome. They're probably in the weekend talking to their friends on Facebook, sharing pictures of cats and dogs and whatever it is.
Yeah.
And this is for me, like, it's like a jaw drop when I read this. I think, like, I mean, I find it always hard to deal with stupidity. Yeah, and that really triggers me. And this is so stupid. This is so stupid, Derek. I mean, I don't have any other words for it. I really don't have.
Is it easy to change pension funds in the Netherlands?
No. I know they're changing the pension system a little bit, so I'm not entirely up to date. But
Okay.
you know, when you're a teacher or stuff like that, that's what you get.
Yeah. So you're really at the behest here of a chairman who, I don't know what his background is.
Informed by the board, and this board has, of course, representatives in it. Yeah, but for instance, in this case, there are former politicians there.
Like, you got to ask yourself the question: whose interest is he looking at here? I mean, he doesn't give a valid reason as to why he's not investing in them. If he said we're no longer investing in them because,
well, they say responsible entrepreneurship, but you know, this is the thing I have with this. For me, we're now at the level that we're doing politics with other people's money.
Yes.
What I believe is, and I think what should happen, some good politicians should write in law that the only goal a pension fund has is to maximize wealth for its constituents. That's the only thing, and that's what they will be measured on and rewarded for. And politics should be left to the politicians. If politicians feel that pension funds are not allowed to invest in certain stocks, it's really easy. Pass a law that even prevents those stocks to be listed in for instance, in the Netherlands. Yeah, and put a UCITS layer on it, on those American stocks, whatever it is. Yeah, I don't think any politician would ever dare to do that. But let politicians make law then, but don't put it in your policy of a pension fund. For me, it should be only wealth maximization, because later on, it's the same with defense stocks. Now companies start to, an ASR CEO this week on the news radio was saying, no, we're investing in defense stocks again. He was asked about this question, but what about people that don't like that? Well, you know, reality changed. That was kind of his answer. Yeah, but you know, now if governments are going to double up their defense spending, and why as a society can you not benefit then from the increase of capital return that you will get from investing in those defense companies? So you're just giving away blank checks. You're not earn anything from it, and you're left with an empty hand. And then you're going to elect officials because you want cheese on the sandwich. Yeah, not cheese with holes, not the Swiss one, the real cheese. And they will not be able to afford cheese on the sandwich when they turn 65 or 67. It's insane. It's insane.
Listening to you, and I know this relates mainly to the Netherlands, but it just makes you realize how little control you have with pension funds in general. I mean, you have no control. Government can do what they want. The board can do what they want. You have no control of where the money really goes. You have these funds with levels that they invest in, which is probably, because I get asked this all the time in Ireland, right? Because it's more tax advantage to invest in a pension. Of course, as you save 40% of what you put in based on if you're on the higher tax bracket. But you have zero control. You don't know what will happen. You don't know, half the time you don't know what they're investing in. It's hard to get that information out of them. And if they could just change it willy-nilly like this without consulting those who it's going to impact, i.e. us, the shareholders.
Well, they will say that they have consulted because they have a governance board, and in this government board they have people representing there. But those are often activists. The regular Joe working somewhere as a civil servant, I don't know, cleaning parks. Yeah.
Yeah.
Will not think about this, but will feel it in their pocket once they retire. Yeah. So I think you have an obligation here, and that's why I think it should be purely on wealth maximization. And you can pass laws about what companies are allowed to be listed or out to be acquired, but that is a job of a politician. That is not a job of a fund manager, in my opinion.
Yeah. And actually, the average Joe will probably not even know this has happened.
Exactly.
Probably will not even know. Anyway, I know you could talk about this for quite a while, and I can see how passionate you are, but we've got quite a bit of dividend hikes to get through. So we could nearly do a whole episode on dividend hikes. It's my favorite time of the year. But let's start with insurance companies while we're on the topic. ASR Netherlands hiked its dividend by 8%. So their new dividend will be 3.12. NN Group also hiked its dividend by 8%. I mean, I don't know about you, but these two companies are in my top 5. ASR is actually my top position. It's grown into that. And NN Group has grown into my top 5 as well.
That won't stop here. Expect another of such a hike. It's in their dividend commitments.
I mean, how often do you get a high dividend yield with high growth?
This is Chowder rule of 15 or 16. It's insane.
Crazy. Schneider Electric hikes its dividend by 11.1%. I'll talk about them a little bit later. Vopak hikes its dividend by 6.6%. Kelly Group, and you brought this one up. It's an Irish company, hiked its dividend by 10.1%. And did you look into the company at all? Because I know you asked me about it.
Not yet, but I would love you to look into it and maybe make a dividend stock card of it for our premium subscribers, or maybe do a deep dive one time on it, because they have a really nice dividend history.
Yeah.
It would be a good mode in this, and it was a bit of a surprise for me when I started to look at it. So I would love you to one time choose it for a deep dive. Or I know the yield is not so high.
It's the yield that was a killer. So it's always a company that I've admired, similar to Glanbia in ways, but this is much, I would argue, much better than Glanbia. But it's that dividend yield. It's always been 0.5, 0.7.
So make a stock card out of it, because you never know what happens to such a company. In a certain moment, it may come into nice territory.
Exactly. BAE Systems hiked its dividend by 10% on last year. No surprise considering what we know about European defence spending. Airbus hikes its dividend by 11.1% and pay a special dividend of €1 per dividend on top of that. So that's 50% of their actual dividend that they're paying out in special.
That's awesome. Special. And I checked a little bit of the dividend history. I believe they had this issue with COVID, right? That they had to slash the dividend or cut it. But this one is interesting. We often talk about Europe being behind, but here you clearly have an example of where Boeing screwed up so much over the last years. I mean, they had the work floor full on coke right there. So, and then Airbus, it seems to just, get deal after deal after deal. And it's really nice to see this company, and it's very rewarding its dividends as well.
Are they in the defense industry as well?
Yeah.
Okay. Yeah, makes sense. Zurich Insurance Group pays a dividend of 28 Swiss francs dividend this year, also increase. Repsol, which is pointed out to us by one of our community members, increased its dividend by 8.3%. There's a lot of big hikes, a lot of big hikes. SAP hiked its dividend up from €2.30 up to €2.35 from €2.20. What do you think of that one? Was it in line with expectations?
Yeah. The cloud business has been on fire, so yeah.
I know you looked at Deutsche Post, but Italian Postal Services increased its dividend by 35%.
Wow.
And they actually have a starting yield of 6% at the moment.
Wow, and that's increase. That's crazy. I mean, I don't know what they do, Italian Postal Service, but yeah, if they're still sending around envelopes and that pays 35% dividend hikes and a 6% current dividend, then I wonder what they are stamping on this envelope.
Yeah, gold or like, I don't know.
Oh my God, yeah.
Maybe they have a picture of Ferrari on it or something, and that's increased the prices. Who knows?
I actually wonder what it is with Italians and sending post by envelope. I mean, I can see the poor guy on the bike driving up the hills and through these little villages, chased by a dog. Yeah.
But you know, we don't speak too much about Italian companies in general. I know you talked about NL quite recently, and I did Sembra PLC, which is kind of a small mid cap. But it's probably an untapped market there for us in terms of Italy. Garmin, we have lots of Garmin fans in our community, and I noticed when we went to Poland, we were all sitting there with our Garmin watches talking about which brand we have and what we do with it. But Garmin had a 20% dividend hike this year. Their dividend yield is getting high. For them, it is now jumping as far as 1.7%. And this is a company I would say it's the yield that's always thrown me off, but it'd be one I would like to look at a little bit deeper. Texas Roadhouse hikes its dividend by 11%. Booking Holdings hikes its dividend by 10%. I mean, man, keeps going double digits. Nearly there. Essex Property Trust hikes its dividend by 4.9%. We've seen that kind of region from nearly all the investment trusts, real estate investment trusts that I've been looking at. Dividend Aristocrat, genuine parts company, ticker symbol GPC, hikes its dividend by 3%. I think they are more of a dividend king. I think they have over 50 years.
They're a dividend king, yeah.
Sherwin-Williams raised its dividend by 10.5%. And this is a company that we don't really speak about a lot, but
no. It's one that we should look into.
Yeah, 47 years of dividend increases, so yeah, definitely we should. Realty Income, as expected, hikes its dividend by 1.5%. Thermo Fisher Scientific had a 10.3% dividend hike, and that's its 8 straight years of double-digit increases.
Wow.
3 or 4 more. Dangar Corporation hikes its dividend by 18.5%. That's ticker symbol D.
That's Danaher.
Yeah, I kind of guessed.
I need to share a little bit about this.
Yes, please.
Danaher was run by a CEO that's currently running General Electric. If you look at Danaher, what he did there was amazing. So when he came to General Electric, I was quite hopeful that he would do the same. You know my story. I sold it in December 2023. And since that time, the company has been like up and north, like amazing. It's the CEO, Derek. The CEO is amazing there. And he did it with Danaher, left the company in a really good shape. He's doing it now with General Electric as well. This CEO, what he's doing now with General Electric, he's pulling off. He deserves a statue. He really deserves a statue because General Electric was beyond repair. So this guy deserves a statue. And I have of course, General Electric, I'm not happy. It's one of my worst investment mistakes and such, how I dealt with it. I used it for tax harvesting. And when the CEO came in, the way he spoke, the way he acted, I felt where he's onto something. But at a certain moment, I just lost patience. And at that moment in time, it started. You have this hockey stick. You need to invest first. You go a bit in depth, but then after that, suddenly it boosts up and you get, that's what he's been doing. And I sold at the bottom of the hockey stick, I guess. But he deserves a statue.
Yeah. Coca-Cola had a nice dividend hike of 5.2%. Walmart with another double-digit 13% hike. And then last but not least, we have Cibus Nordic Real Estate. They keep their dividend flat, but it's a high yielder, right? So it's probably
it's a high yielder. It's a high yielder, and it's good. They did some acquisitions, so that should trickle down into the earnings over time. They're getting much better in their debt management now, so I think this was expected for me.
Yeah. So quite a list. A lot of big hikes we're seeing this year. So especially from these insurance companies, and we're going to talk some earnings. So maybe let's start with one of these insurance companies.
Yeah, I just want to talk about ASR. I mean, this CEO as well, amazing. I was listening to him at the Dutch news radio BNR really briefly this week as well, and the way he talks, the way he comes across, I hope he will stay for a long time. I'm afraid not so. He's doing really well, and if you look at it, so they bought Aegon insurance part, and they have now integrated already. But that's why you see that the what they call the organic capital creation, it's kind of their term of free cash flow, grew by 36.5% from 874 million to 1.2 billion. Their solvency ratio from that, after that acquisition, it dropped to 176%, moved up back to 198%. So if you think about that, it's quite amazing how well they were integrating the company already. They have already, what they say, realized 50% of the synergies of what they saw. Like, I think about staff, right? So they reduced their workforce already by more than 500 people. It's really bad for those people, of course. But it's what you do after an acquisition, right? And I think they may still have some staff to be let go, but also their application landscape rationalization when it comes to IT systems and such. They've been on top of this. Unbelievable how it already trickles down into the company's earnings. So I'm quite impressed with this, and it seems to be really a smart acquisition. So with that, all numbers are generally up. But also, for instance, when you think about non-life insurance here, so their premiums have been going up. They have been increasing it by 5.1%. Well, I've noticed that, not that I have ASR, but for instance, on my car insurance, again, went quite up. My wife was complaining, and I said, like, don't worry. We own Allianz. Yeah. We're paying ourselves. And it will come back in dividends. So don't worry. Yeah. And she looked at me and said, yeah, that's the beauty of owning companies that pay a growing dividend for the products that you consume yourself. Yeah. The same when I go, I told the same when I go tanking. Yeah. Shell is paying for this. Yeah. And when we invested back into Shell, it's like the circle of life, as I would call it. So, but you see that the insurance companies are hiking all their prices there. And this turns back to the bottom line. So I'm very, very positive about all of this. And there's another thing that they're looking at. So what you need to know is, like, ASR operates in the Netherlands. And by the way, when the guy was asked on the radio, like, will you ever consider going abroad? And he said, like, no, on abroad you go for vacation. Business we do here. I love that statement. Yeah, they said there's still so much more to earn in the Netherlands before they would consider international expansion, which they also consider as much more complex because European legislation is not integrated, so it would really make things complex for them. But you need to know that in the Netherlands now there's, I think, a law being passed and everything, and now pension funds are considering selling their funds to companies like NN Group and ASR. Pretty much what Schneider is doing. They're buying pensions, here with the obligations still for payment in the future. And it's kind of a hedge on, how long do you expect those people to live? Yeah. And then does the cash flow that it returns gives you in return, does it justify it? So ASR did a really large buyout of that as well last year, 1.6 billion deal that should be approved somewhere this quarter still. But this again could really add to some nice growth in the years to come. This is one of the catalysts for both NN Group and ASR. So more to be seen there. I expect many, many billions of deals coming the way of those two companies. So yeah, hey, just a really good year. They hiked the dividend as well again. So the 8% increase that you spoke about, it's now €3.12 per share. Of course, we saw already with the interim dividend last year that a lot of this 8% was already generated in the summer, but year over year, we've got now a nice full one. They have announced another 125 million share buyback on top of what they were doing already in Q4. So they are just very cash rich at the moment. They bought back in 2024 quite some shares as well. So if you think about it, Yeah, they've turned on the buyback machine right now as well. They don't know what to do with the cash because the solvency ratio is now on 198%.
Yeah.
Expect this to grow potentially above 200, and everything beyond that will be dividend hikes and share buybacks. I hope they prioritize a little bit share buybacks. So not that they give us a 25% hike, and then after that we get the legal general situation, only 2% hikes. I rather see them using, for instance, a 4% buyback each year, so that this buyback then allows you to give at least a 4% dividend hike. That's what I'm hoping for, so that I get the benefit of both owning more part of the company and at the same time have a little bit of stability in dividend hikes as well. That's what I prefer at this yield.
Yeah.
So
Yeah.
don't forget it, an A-rated balance sheet, right? So
yeah, A-rated balance sheet. They've improved their financial leverage. So it was 23%, well, nearly 24. It's down to 21.7. Interest coverage has gone up. They've strengthened their balance sheet, bought back shares, increased their dividends by 8%. I mean, quite nice. It's quite nice.
It's like a golden shower.
But we talk offline a lot about this, and we have a lot of insurance in our portfolios. And at what stage do we have enough? Because they still seem like, honestly, they still seem within a good valuation range. They're trading at €49 at the moment. Still seems quite reasonable for them. So, and then you have NN Group, which we speak about. We have Legal & General. We have Schneider as well, all seemingly trading around good valuations. At what point do you say I have enough insurance, which is the question we kind of ask ourselves all the time. But we'll talk about NN Group in a few moments. But I'm a happy shareholder. As I said, they've grown into my number one position because their share price went up. I think my average share price is around 42, 43 euro. I have around just over 200 and some shares. I can't remember off the top of my head, but it's now 7% of my portfolio, which is quite significant, I would say. But let's park that for a moment and have a look at Schneider Electric. I wrote about these on our premium newsletter. They are piggybacking on the coattails of these mega trends. We talk about electrification, we talk about renewable energy, all that kind of good stuff. We're in a digital age. And honestly, they've been on fire the last couple of years. I went back and had a look at their predictions from last year, what their targets was. And this is a habit I'm starting to get into a little bit more, trying to see what companies are saying and what they do. Because if they don't meet it, sometimes you have companies saying, oh, it was as expected. But they change their tune halfway through the year. So what they said last year is that, and they normally predict their EBITDA, but their EBITDA organic growth will be between 8 and 12%. The revenue growth will also be around that. And also they said they would increase their EBITDA margin. Okay. So then we look at the figures. Revenues were up from 36 billion to just over 38 billion. That's an 8.4% change organically. Bang, right? They hit their target. Adjusted EBITDA, that also grew 14.2%. We're talking about organic change. Reported change is 10.5%. And their EBITDA margin improved from 17.9 to 18.6. So the good news is they did exactly what they said they would do, which I'm quite happy about. But I think the overall story with these is quite strong. They are, as I said, hanging on these coattails of megatrends. Energy management is up 12%. Surprisingly for me, well, not really surprisingly when we look at Siemens from last week, industrial automation is struggling at the moment. That was down 4% year on year. That's struggling at the moment. I think there's a lack of supply. That whole area is kind of in transition at the moment. So it's the other areas, particularly around energy, electrification, that is pulling this company up. Energy management, as I said, is up 12%, which is double digits. Across the world, North America was up nearly double digits. Europe was up high single digits. So they are well diversified. Free cash flow was 4.2 billion, which is slightly down, but it's down 4% because of increased capital expenditures. And we can blame R&D for that. They've brought in some new projects. Their dividend, as we mentioned above, was up 11% to €3.90 per share. So I think overall it's been quite a strong year for this company. The data center networks grew double digit. They have this buildings segment, which also grew double digits. Infrastructure grew high single digits. So the only real struggling one is industrial automation, but I expect that to turn around in honestly in the next couple of years. Anyway, so not too concerning, but yeah, I think it's a nice company. I do honestly believe that the last, say, 8-9 years, they positioned themselves so well. They were like a company in transition without being in transition, and they were aligning themselves to take advantage of electrification in this digital world. They are delivering, I mean, double digits again.
Wow.
They are expecting that again next year. That's their guidance for next year. So, yeah. I mean, I had a couple of shares of these, and I had a lot of companies in my portfolio, 50 or 60, and I was taking out companies where I had like 4 and 5 shares, because at the time I either didn't do enough of a deep dive or didn't have the conviction. And these were always on my list. They would have just got to them too late. So I sold my 5 shares. I don't have a position. But I think it's a fantastically run company. I love their products. I use their servo drives, their pack drives, their PLC on a daily basis. I also use Aviva, which they bought recently from Underwear, which is also great. So I know this company quite well in terms of their automation products.
And it's compounding, unbelievable, right?
Yes. So,
It's compounding. So maybe you should reconsider your thoughts.
I have, but I mean, I won't give away what my fair value valuation is because that's in a premium newsletter. But that's the only thing that was holding me back is valuation. But the problem with valuation is that's based on my assumptions. So I could be wrong. I could be wrong, but that's my only thing. But I mean, if this company drops, I'll be ready. But I mean, when they're turning out numbers like this, when they're growing double digits, I might be waiting for quite a while. That's the problem.
Awesome. Well, it's also a company that would fit in my portfolio. One of those industrials that I believe long term in. Yeah, let's see. Maybe one day we will get an opportunity with a global blackout on the stock market or something like that. Let's cross fingers for that. Good. Hey, I have to talk a little bit about the brother of ASR, and that's NN Group. I mean, I referred to it already a few times. You know my thoughts, right? ASR, I trust their management just a little bit more. I think it's the most boring CEO works at ASR, exactly what it needs to do. And NN Group has a little bit more of an, not flash boys, but let's call it the management that, has a bit more ego than others. Let's call it like that. Yeah.
It's the little brother that wants to be seen. That's
yes, I think so. Although they generate more in cash than ASR still. So actually ASR's, I think maybe NN Group is the oldest brother. But that is the I said NN Group is the oldest brother, but that's the one that's always having problems. And then the youngest brother is like the nice brother that always prepares the homework and such. I think it's a little bit like that. Yeah. So first of all, let's start again. What I love is actually that almost their first slide is saying continuing our attractive capital return trajectory. I mean, what a tongue twister. Can't they just like growing our dividends or something like that? Anyway, 3.44 euro in dividend per share, 8% hike from the 320 before, which means like a 6.6 billion in dividends paid and then 3.5 billion in share buyback. If you look at their chart, their share buybacks are also growing with a certain percentage each year, which is also very interesting to see. But they returned 10 billion in capital to its shareholders this year. And if you know that, right, what we're talking about here at this moment in time, we're talking about a 7.4% dividend yield and another commitment of dividends of 2.5%. So you're getting already a 10% return on investment. Yeah. And then you have still capital appreciation as a potential, because I would say the price to earnings and such are still relatively low. So this is what I like sometimes about these companies. You already have a 10% of the get-go.
Yeah.
If you invest in a Walmart or something like that, you don't have that, as such. And so, I mean, it's really, really difficult to beat this kind of opportunity that you have. And it's probably good that these are listed in the Netherlands, these companies, not so much known by other countries, not so much known by Americans. because if both ASR and NN Group would be trading on the New York Stock Exchange, I think they will be yielding for a 2.5% or something like that, 3% max yield. So, which is good because we get way more bang for our buck. But the group solvency as well here increased to 194%, or is now at 194%. Like ASR, they wanted to be between 150 and 200%. So they have a buffer for a rainy day if something is supposed to happen. They also are doing well. So their insurance business, Europe, was supposed to have a goal of in 2025 to reach 450 million in operational organic capital generation, and they already beat that. Their life insurance was flattish; it grew only 2%. Yeah, so it's a business that can do. I mean, it's a stable business. Let's call it like that. Also, their let's say their OCG, which is their form of free cash flow, grew by 1%. Yeah, so from that point of view, it's flat here, but that's just a really good year last year already. So if you think about it, and I don't want to make it much longer, like I said, about I said just 11.5 billion in market cap. Yeah. So if you buy back another 300 million in shares, you're talking about 2.5% yield on buyback plus a 7.4%. It's like a 9.9% total shareholder yield. I mean, that's what you get from NN Group. They are committed to continue growing the dividend in the mid to high single digits. So expect more or less the same next year if it continues to operate like that. I think the buyback will already generate 2.5% of the dividend growth for next year. So maybe we'll get another 5% on top of that. And I think we may see more buybacks if it continues on these cash flow generation. If it continues the journey, I think we could even see more.
Yeah. I mean, you can see on their slide they have this nice dividend history also with the share buybacks, and they've been consistently increasing both. Which exactly. I think you need the little brother to speak to the big brother, ASR, to copy this type of capital allocation strategy. But they are a little bit more diversified than ASR. Their management are a little bit more eccentric, I would say. I think that's fair, but I mean, you can't argue with those type of returns for the last 10 years. So another happy shareholder, I have to say. And still relatively, I'm not going to say cheap, but the valuation looks still relatively
cheap. Exactly.
Which is hard because every time I look, I see what they're trading at. So I want to buy more. I can't buy more.
That's already for 2 years.
Yes.
It's not like it's like for the last 3 months that we went full into it. No, this is already like a pattern for 2 years, right? Every time, maybe I should buy some more. I can't. Maybe I should.
Yeah. And then you leave it off this month. Next month, you're back in the same situation. I'll buy 10 more.
Yeah, because I'm not like Warren Buffett that I feel comfortable having 50% on 2 stocks in my portfolio.
Yeah, especially insurance.
And specifically not after 14 years on the journey.
Yeah. Okay, let's move on to a real estate investment trust, VICI, ticker symbol VICI. You know, this company, I have a lot of shares in my portfolio. The revenues increased 6.6% year over year to 3.8 billion. Their adjusted funds from operation, which is what dividends is paid from, increased 8.4%. And they increased their dividend almost half of that by 4.2%. So kind of like a solid year overall. They've been investing heavily. I mean, it's a relatively young company. I think for 7 or 8 years. So they're still in that early growth stage and they're investing a lot of capital. Last year, they committed around 1.1 billion in capital, and the return on this is 8.1%. I mean, we'd be happy with that. Let's be honest as investors. Some of the notable, I would say, investments are in Homefield, Kansas City, where they have this 105 million construction loan for sports facilities. There's an upgrade going to the Venetian Resort in Las Vegas. You've never been to Las Vegas, but the Venetian is incredible. It's like Little Italy. You can go on little gondolas and they have canals and go around the whole hotel. It's amazing. But that's due an upgrade, so they're helping out with that. Great Wolf Resorts, there's a 250 million loan finance and packaging, and there's also casinos in Canada. So they are expanding a little bit outside of Las Vegas. We've seen that. I've also did a deep dive on these. So we've seen they're starting to do that. I mean, there's only so many hotels in Las Vegas. Let's face it. So they have to expand. We still have 100% occupancy ratio, but I mean, you look at all this that they're investing in, and you need money to do that. So most of this is done by issuing debt or issuing shares. And you can see that their shares increased around 17.1% last year. And they've issued 1.8 billion in debt as well. So you have to look at the balance sheet in this type of company to see, okay, is it okay? Is it not? The good news is that they've got strong liquidity. So they've got around 3.3 billion in liquid assets. That's not all cash though. That's around 500 million in cash, and the rest is this credit line that they have. So it's about 2.4 billion in available credit. Their debt is spread out to about 2054. So it is evenly spread out, but what you must know is that there is roughly around 1.5 billion due in 2025. They don't have that money on their balance sheet, on their cash, as I just said, so that'll have to either be refinanced or they'll have to pay that by some other means. So again, it's just something to be aware of. They have a similar payout in 2026. And then after that, the next one is in 2028. So it's just something to be aware of, that they do have these loans that need to be paid. But I mean, other than that, they're continuing with these investments. Their occupancy is quite high. It's doing really well. I mean, I can't complain with an 8.4% adjusted funds from operation. And what I like is that they are paying out less than half of that. So it is sustainable, this dividend. You just have to be aware of their debt position and their issuance of shares and how that's playing out, particularly as they're in this growth stage, I would say. But overall, I'm quite happy. If you look at their share price compared to Agree Realty, for example, when all these investment trusts went up, VICI has gone nowhere in the last 4 or 5 years. It's gone nowhere. It's still pretty much the same price as it was in 2021. So by my book, it's still really, really, really good value. But again, there are some risks with this type of company. So I can understand why it hasn't moved up as much as Agree Realty. But their credit rating has also improved, I must say. So that's also a good sign, I think, with real estate investment trust. I think Moody increased it from BAA3 to BAA1, which is 2 steps higher. So I'm always happy when I see that.
Good. Yeah, I don't own it yet, but sometimes I have this feeling like maybe I should here with VICI.
Yeah.
And I am looking a little bit more into real estate investment trust lately, because I think I own too little of it. But then, for instance, I do love company like the small cap like Defama in Germany, as an example. So usually I'm eyeing that one.
Yeah. But you've also got CBUS as well, so you're quite more diversified with that.
Yeah, but mostly it's not so much diversified, because CBUS is in the food chain, so the groceries. Defama is also having the Lidls of this world. Realty Income, similar, a lot of the supermarket chains. And then Agree Realty, similar, so I'm really in that kind of business, because I strongly believe that there will always be foot traffic to such locations, and I don't see the shift to online shopping like that so fast happening, that people suddenly, that the companies will have to stop investing in the real estate and only have it directly from the logistics. I don't know about you, but I prefer to really go shopping in a supermarket.
Yes.
I always buy more than I need. So maybe I should buy online stuff, but online, I mean, actually you want to go outside sometimes, right? So
yeah. But simple things like buying bread. Let's say you want to buy bread. You buy this online. Some guy will go and just pick up the first piece of bread and throw it in a basket. That's what you get. I like to go and check the date. I don't want to buy bread that's out of date tomorrow, which is usually at the front. So you usually take it from the back. Just simple things like that. That's why I prefer to go.
Actually, me too.
But look, back to VICI, they trade at a 5.54% dividend yield, which is not too shabby, to quote Rian. And with a 4.2% dividend increase, you're getting a chowder of around 9, which I think is acceptable for real estate investors.
Exactly. Yeah, really good.
Okay, we go to some of our listeners' questions. We've got quite a few to get through, so we'll start with Matthew.
And let's go fast through it because I know you'll have private plans.
Yeah. I know we'll take our time with the listeners. But Matthew has asked us how we analyze earnings so quickly. He's looking for some tips because he's impressed at how quickly we do it. And I'm going to just say how quickly you do it. You do it a lot quicker.
Yeah, but I'm maybe to clarify, I'm not necessarily analyzing earnings. What I'm doing at this moment in the season, I'm looking at the dividend hikes because it's mostly those European. Now, very simple. I'm using the Quarter app. Yeah, that for this season, I have the paid subscription. I've got my watch list in there with all the companies. I prepare in the weekend also these earnings calendars that I share on social media. So I've got that all prepared. And, my routine looks like it's like I wake up at between 6 and 6:30. And then at 7, I'm sitting with my coffee. I do it for 20 minutes, half an hour. I pick all the dividend hikes and I share it on social media. That's what I do. Then sometimes still I tune back in around 8 because that's when the next cohort comes with European companies, and that's it. In other quarter seasons, I usually take 1 or 2 in the morning, and then I read the reports because those reports are not so long, and I know already what I'm expecting. So I've prepared that, let's say in the weekend, what to look for. I look for that, and then I share my thoughts. But it's usually literally just the highlights. Then in our premium newsletter, you and I will often take 3, 4 earnings and go a little bit deeper into that. Yeah. So that's typically how the process looks like. So because I'm just I'm a dividend growth investor. I'm very passionate about the dividend hikes. And for us, this is like what for financial controllers December is, right? The year end. For us, this is the season with all the European dividend hikes that I just plan for it. Yeah.
I'm thinking of the question in the context of an investor that's not as passionate about every company, more so their portfolio. And I would say the Quarter app, you don't have to pay for it. The free app is absolutely fantastic as well on your phone. You get a little notification when the earnings is upcoming. You can listen to the call if you want, but I find the free app is perfectly fine. But if you're short on time and you want to filter out what to look at and what not to look at, wait for the earnings to come out. Look at the share price. If it drops 4 or 5%, maybe you need to read that. Stays flat, you probably don't need to do anything because there's nothing exciting. Just read the headlines and make sure you're happy. That's probably the quickest way to filter out what.
Yeah, because we are long-term investors. The quarterly earnings actually don't matter so much. I would say really familiarize yourself every year with the annual report. If your thesis still stands, if it doesn't stand, ask yourself why. Ask yourself what you want to see change. Ask yourself if you want to continue holding it. And then with the quarterly earnings, it's indeed to you. If suddenly the stock market changes very abruptly, then maybe something that is impacting your thesis. Yeah. Look at it, and that's effectively it, because we don't need to really sit on it quarterly.
Usually it's around forward guidance. Usually when you see a drop, it's forward
guidance. And that means like, buying opportunity.
Exactly. Because if there was, normally when there's bad news, it comes out not just at earnings season. They don't wait to release the bad news. Bad news just comes out naturally. So usually, not all the time, but usually it's that. So but that would be my tip. Just wait, have a list of companies you want to assess, use Quarter app. And if the price drops, have a look at the headlines, have a little bit look deeper to see why it dropped. And
exactly.
Okay. Marcus wants to know about companies that give us guidance. So, for example, they give us guidance in 2025. Is there any laws or guidance that they must comply with when estimating future earnings, or can they say whatever the hell they want? Because sometimes it just seems like it's unrealistic.
I have no clue if there are laws about this, really not. I assume that they may not say everything. I assume that if they would be simply lying, like plain out lying, and therefore have created, let's say, have been pumping up their stock, and then in reality doesn't come, and then for instance have been selling shares on the top as insights, I think that will get the watchdogs on them. So I assume there are some ethics related to that are probably written into law, but Yeah, I sometimes have a feeling like, why should companies even give guidance? Of course, you want to hear from the CEO about how the business is doing and where they see opportunities. But I don't need guidance in terms of numbers. I think what these guidance are typically for is making analysts' lives easier so that they can plot it into their model and therefore can give a buy, hold, or sell rating.
Yeah.
And probably the analyst community is pushing for it and asking for this. But I just want to know, for instance, from an NN Group, I just want to know, like, okay, what is your expectation in the life insurance and in the non-life? Do you see any red flags in the market ahead? And usually they start talking a little bit about macro, weaker consumer. That's what I'm interested in. I don't care what number they stick to it. Yeah. But sometimes, I mean, to your point, what you said earlier, if you see they stick numbers to it, you want to check how good they are at it. Because I love CEOs that are using the UPOT method, like the under promise, over deliver.
Yeah. I mean, if they're consistently giving guidance that is above what they achieve, well, then what is the point in even listening to that? Just ignore it completely. Do I think that they are lying? I don't think so. I think most companies, and I can only give experience from the companies I'm in, but you'll have these marketing teams, you have these sales teams. They'll be out on the street, they'll be talking to people, they get a sense of what is needed. They'll come back with their projections over 1, 3, 5, even 10 years sometimes. Give those. So that's been fed back to the board. They're probably taking that and being a little bit conservative, maybe sometimes, or sometimes they might just take it at face value. But
it depends on the management style.
Exactly.
I think, because you have people that are just always optimistic about everything. And they see like, but why would I worry about one bad year? But it will cost you your overall growth rate. But fundamentally, they will talk like, and others are just always looking at it from a negative point of view. So I think it reflects life a little bit.
Yeah. I like when they give guidance because they have access to more information. Well, they should have access to more information than what we have in that particular market. So it just gives you a good guide of where they go.
But I don't need guidance in terms of earnings. I want guidance in terms of outlook, in the sense of what can you expect knowing their customers. That's real information. Let me do the assumptions further.
Exactly. But if they give guidance, say 10%, and they hit 7%, I'm not too disappointed. The share price will drop because they didn't hit 10%, but I'm not too disappointed. Now, if they give guidance at 10% and they grow 1%, I'm going to ask why.
Yeah, exactly.
Why?
Exactly.
Why is that?
And then also, I said, when they say 10%, I almost never ever would take 10% in my own assumption. I look really at the historical trend, payout ratios to understand like what's the margin they have to grow the dividend, or the free, and therefore also or to grow the free cash flow. And from there, I try to put, based on all the years of experience, a reasonable percentage growth number based on what they tell about their business outlook. And if they say 10%, I will typically go with 6 or 7%.
Yeah. And there's a follow-up question to this from Ketan, and it is, say management always pass comment on previous years, but a lot of this doesn't seem to align with what actually is the reality. So how do retail investors read into this, and how do we cut the chaff from the wheat?
Business analysis. I mean, for me, it's actually a bad sign if there's a lot of bullshit, because it means management is not trustworthy. And if you can't trust them on the basics, then the company needs to be so strong that you know that any idiot can run it.
Yeah. Like I'm not going to bash IBM like we usually do, but we did a deep dive on them, and if I remember, we went through maybe 7 or 8 years of annual reports with the guidance, and every year it was something new.
Yeah,
and they never really commented on what
the next year. They didn't talk about it anymore. It was suddenly gone.
Yeah. So like they built up this hype, and then it was gone. It was like Game of Thrones, the ending of Game of Thrones, when everybody's disappointed. That's what it felt. That's what it feels like.
Yeah.
So I think you get a feeling of that over time, depending on the CEO. Just go back over the last 4 or 5 years, have a look what they said the previous year, compare the following year, and so on, and you'll quickly see a trend.
Yeah, exactly.
Adam has said that he's read an article about the total UK stock market has net outflows for 23 out of the last 24 months. And this is mainly due to the government putting restrictions on UK pension funds investing in stocks. You ever consider that no matter how good the fundamentals are, the fact that the index as a whole is constantly having outflows, it will never be able to perform.
As long as the dividends keep growing.
Yes, I was going to say that. So you're looking at this from a share price.
Yeah.
And yes, of course, you want the share price to increase over time. And you would have to think that you're not going to have outflows forever on the UK stock market. Otherwise, it will just disappear.
Well, in that case, I would be a business owner soon, because then I would be the last one with shares in Legal & General. And then I will be the chairman of the board of Legal & General. I will be the chairman of Schneider. I will be the chairman of whatever I own from London Stock Exchange. So I don't mind that, actually. Yeah, but I think what I'm worried about sometimes is the impact of index investment on the stock market. What I mean with that is, like, you see already over the last years that when there's news, just because people are automatically investing in index funds, there's always coming liquidity into the market. Yeah, no matter if it's a shit stock or not, if it's part of the S&P 500, there is liquidity coming into that stock automatically.
Yeah.
That's why I think we see these high PE ratios as well, because of this constant flow of liquidity. The moment people have no money more to invest or less, and they start pulling money out of the index funds, it has nothing to do with valuation anymore, whether your company is valuated well or not. It will just trigger an immense sell-off. That's what I'm afraid of. So I feel like the stock market will become much more volatile over time with those quick crashes. But at the same time, just what we have seen over the last decade going up and north. But I'm so afraid that one time when everyone starts to sell their indexes, their ETFs, that we will see a massive sell-off, because then, it's like throwing the baby out with the bathwater.
Yeah. But look, I think ultimately for UK stocks, I think focus on fundamentals.
Yes, exactly.
Forget the macro. You can't change the macro, and eventually you would hope the share price will catch up to what it's supposed to. Eric Mead, one of our retired early members, has asked us our party choice beverage and best dancing moves.
Yeah, we spoke about that already. No, nothing there, but I mean, yeah, no, nothing there. I'm not really an alcohol drinker as such, like maybe one per weekend or something like that. And I'm more for the cocktails, so I think you go quicker to more the liquor brands.
Yeah. I'm more of a Jameson ginger ale and lime kind of guy. I do like that drink. In terms of dancing, I'm just like that old man tapping your foot, and but I'm not a great dancer. But
well, maybe in the next dividend day we should go to a club to party and check each other's dancing moves.
yeah. Be back in the 90s, all these little fish, big fish.
We can say, like, we can wear t-shirts going in like I'm a passive income investor or something like, or look who's your daddy now. Yeah, something like that.
Yeah, all the ladies will love that.
I'm a sugar daddy. Yeah.
Elo has asked us about our dividend growth portfolio and how dividends paid out into relation of your total net worth in a financial independence scenario. So he says he knows we typically consider that a pension is nothing that we're planning for, but he's just kind of curious how dividend growth and dividends paid fits into our total net worth.
Well, I calculate my total net worth, let's say, like how you do it, right? You look at your liquid, like a balance sheet. You look at your liquid assets. You look at your plant property and equipment. Yeah, and then you put your debt on the other side, and then you have your shareholder equity. That's what I typically do with my annual calculations in my annual report. I don't give the absolute numbers, but I give kind of the debt to equity ratio and such, how much my return on equity was. So I do that, and I would say that the liquid part of my portfolio is growing faster than the asset side. Yeah, so effectively, my portfolio grows faster than the worth I have in my house, as an example. But my house doesn't pay dividends, so I don't really understand the question from that point of view. But that's why I mostly look at only my dividend portfolio to my FI. I don't look at my retirement savings. I don't look at my pension, because I do invest a little bit with my wife into this tax advantaged here. But I don't look at them because I can pull that money into early retirement. Yeah, so I don't look at it from a financial independence point of view. I purely look at my dividend portfolio for financial independence, because that's money I can consume at that moment in time.
Yeah. And when I look at that, I look at my dividends paid out in relation to my total net worth. I would imagine dividends in the beginning will be 100%, because that's my main source of investment at the moment.
Okay. Yeah.
So, the second part of that question is around pensions, and he mentions that it's nothing I'm planning for or we're planning for. And I don't think that's entirely true. I do invest into a pension, it's company matched, but I don't put that into my retire early calculations.
Exactly.
Because I can't access that till I'm 65. So
Yeah.
when or hopefully if I reach that age, I'll be retired on my taxable money for my own investment accounts, and then that'll be a nice little boost that I'll get in the future.
Yeah, and then the issue with that is that you're then already in an age that you don't benefit from that boost anymore. So people that retire typically spend much less.
Yeah.
So, and that's a pity, actually. Yeah, that you can't bring that forward somehow without being taxed the hell out of it.
Yeah.
But what do you need with, when you're 70, you're not so mobile anymore as when you're now in your late 30s. So now you need that money, not then.
Exactly. There's a book, Die with Zero, that talks about
exactly.
Yeah, it's a nice book. But yeah, look, when I get to 65, and you know what? But that keeps increasing. That could be 67, it could be 68, it could be 69 by the time I reach that this is paid out. But if that happens and I get that boost, more than likely that money will go to my kids. It'll go to
I will be this grandfather that is giving envelopes with Christmas that that my children will say like, "Thank you, Daddy." Yeah.
Okay, we have some stock-related questions, and Dara has asked us about Occidental Petroleum Corporation. What are your thoughts on this at these prices, given the Warren Buffett ties?
Yeah, I looked a few times into this business and it just doesn't fit in my portfolio. I've got Shell, ExxonMobil, Chevron. I prefer to have those asset owners. So I understand what Buffett sees in it from an asset point of view and also a shareholder yield point of view, but it's the joy of missing out on this one.
And our friend Tiago has asked us why is he spending his time building a screener for Japanese microcaps when he can just buy Jackson?
I have no clue what Jackson is. This is Jackson Financial?
Yeah.
And what does it do?
I'm not entirely sure I'm not up to speed with the company. I know Tiago speaks quite highly of him, and he's been right with a lot of stocks that he's really gung ho on. So I'm sure they're quite okay. But to answer the question, I don't know why you're building a screener for Japanese microcaps. But there's some good companies in Japan. We spoke about this before. Keyence, Nintendo.
Yeah. Well, I really have nothing to say on this. I have no clue.
Okay. Hunter Bagger has asked us, have you ever looked into decisive dividends on TSX, Toronto Stock Exchange?
So I never looked into it. So I looked it up before the show, and I'm quite surprised that I thought like, what is he talking? Is this like a service? And then I really no, there's actually a company named Decisive Dividend Corporation. So it's maybe just a small intro. It's an acquisition-oriented company that focuses on manufacturing-related businesses, typically small caps. It is typically thinking about, I guess, business owners that want to build a legacy. You know, when you get old and you want your company to be in good hands. So I think that's what they're looking at here. It pays a dividend yield of 9%. It cut the dividend, unfortunately, in 2020 by 33%, I believe. But since then, it nearly doubled. So, and I think it's paying it in a monthly. So this could be a very interesting one. So something for one time. I mean, adding it to our long list of companies that could be of interest. And I really love it that our listeners are often bringing these kinds of companies forwards. But to respond to Handelsberger, it piqued my interest based on what I saw.
Yeah. And you know what? I don't know a whole lot about the company, but I would give them a pass for cutting that dividend in 2020, considering the industry they're in. They sell wood burning stoves, fireplaces, inserts, gas fireplaces. Who the hell was buying them in 2020 when we had COVID? So I won't be too hard on that. But 100 bagger, this could be an opportunity for a 100 bagger. If it's a small cap, there could be plenty of opportunity.
Yeah.
So let's see if we get to it. It is on the Canadian Stock Exchange as well, which is something to note. I know we don't have a lot of Canadian stocks. We don't look at that quite often. So let's see. We might look at it sometime. RMS. I believe you talked about this one before. But can you talk about Brookfield Asset Management? Seems like a good starting yield with high growth projections. So what I'll say about Brookfield in general, it has quite a complex structure. So you've got Brookfield Corporation sitting on top, and you've got all these other subsidiaries sitting underneath it. And Brookfield Asset Management is one of these companies. It is an asset-like company. And what I mean by that is it doesn't really own the assets that it's managing. So it manages most of its assets from Brookfield Corporation. So you really have to look at the two companies in tandem, because most of their revenue will come from management fees. So if Brookfield is increasing their assets, that means that Brookfield Management will increase its management fees. They do make revenue from other avenues as well. Honestly, I believe Brookfield is a really, really well-managed company overall. It can be quite complex in structure. They've also got energy and infrastructure subsidiaries as well. So it can be quite cumbersome to get through all them. And maybe that might be a deep dive to do in general. But I like Brookfield Asset Management. I bought them just before they popped. I bought them at around $45, $50, and they nearly doubled in share price almost immediately. It was actually good fortune, because somebody emailed us on our newsletter to ask us to look into them. I did. I was quite impressed. I said I'd buy a small portion. I bought about 50 shares at that time, and it just popped straight away. So I was quite lucky. But I like this. I like this. They're buying up. There's lots of assets. They're in this renewable energy space as well, particularly in America, Canada, but also in Europe. Yeah, I like them as a company, and I think they are definitely worth doing a deep dive on. And of course, they had a 15% dividend hike as well. Who can argue with that? But there's lots of talk. Who would you rather, Brookfield Corporation or BAM? I prefer BAM because of its dividend yield, but if you want more growth, capital appreciation, look at Brookfield Corporation, I would say. Really good companies. We got a question from Viv, or something with dividend, I would say. I can't pronounce that name, but what is the equity story of Vopak, and why not invest in them?
So when we talk about equity story, I mean, it's a Dutch dividend grower. It owns all those terminals that you see typically in the harbors, where they will store oil and all kinds of other liquids. How do you call this? Liquid commodities, yeah, that are used for energy and such. So, and there's a very solid business. When it does typically very well actually when the oil price crashes, because at that moment in time people would like to store it and not use it yet, so that they can sell it later at a higher price. And it has been growing the dividends for many years, and cash flow also solidly there. So I think there's a really good story of Vopak. Why not invest in it? I ask myself that question as well from time to time. I think it has to do more with sometimes when at that moment, in those moments in time of valuation. But on the other hand, I own already quite a lot of energy for my portfolio, and I always wanted the other part of my portfolio to start lifting it up to reduce the overall energy exposure. So I guess that's mostly the reason. But from a business point of view, there are not a lot of reasons not to own it other than your portfolio strategy. That's how I look at it as a dividend growth investor. Yeah, don't expect capital appreciation kind of wonders, miracles. No, it's a very stable slope compounding business.
Alexandros has asked us about another Dutch company called Koninklijke Heijmans, ticker symbol HEIJM. It has an attractive dividend yield and PE ratio.
Yeah, I'm staying away far from this kind of stuff. It's not a business that is having longevity in its dividends. These are the construction companies that build real estate, houses, and everything. And I know they are building, continue to build housing and everything in the Netherlands. But we saw it with the great financial crisis, together with Koninklijke BAM and Koninklijke Heijmans. They went into the shreds. Yeah. So this is not a company that you want to own when there is a strong recession going on in the country.
Yeah. I think these type of companies you buy after they've dropped quite hard, because there's usually a crash in the economy.
Yeah, but then you're like a value investor, I would say. I would not buy them for the dividends.
Yeah. What is it with those companies? They all seem to give attractive dividend yields. They spoil dividend growth investors over there.
I don't know, actually. I don't know. It's not like in the Netherlands is an investing culture.
Yeah. There's a big investment community there. Wim has asked about Castellum. A few years ago, there were many positives about the company and its potential. We all know what happened then, including a dividend cut. He decided to keep the shares and bought some extra when they were down quite deep, because he kept believing in their potential. Now they've restarted their dividend in a modest way and obviously kept it flat. So what are you thinking?
Yeah, I mean, I'm anchored still psychologically to what happened then. And sometimes we know like the sun starts shining, after the rain. So it may be very well, but I pulled my money out and put it in Cibus at the time. So I got even more dividends out of that money that I put into Castellum after it. And if I look at the growth that I've experienced with Cibus since then, even I've got a big like dividend wise flat, right? But if you, in terms of capital appreciation, actually what happened after that, it's crazy. Yeah, so 40% increase for me since then. So I'm very happy that I moved into Cibus. I feel that my dividends are much more stable there. I protected the dividend income cliff by keeping my shares in Castellum. So from opportunity cost of view, it has really played out well for me, and that's why I'm not looking back at Castellum again. But to his point, sometimes, but it depends on this new owner, right? How much you want to trust this owner, I would say, because due to this owner and everything, all this mess started. So, and the former CEO as well, of course.
Cool. Daniel has asked us what percentage of our portfolio is in ASR and NN Group, and why is it so low?
I give you two numbers.
Yes.
3.46% in terms of capital. Yeah, so in terms of value, portfolio value, but 8.6% in terms of dividend income. And that is quite high, having nearly 10% in two stocks in dividend income. It creates a strong dependency. And yeah, I feel a little bit uncomfortable to make it much higher, but is this time different, right?
At the moment, ASR is around 8% of my portfolio, and NN Group is 6%. So actually,
in terms of dividend income or in terms of value?
No. In terms of value. I don't know what it is in dividend income. I can't find it quite quickly.
Well, you need to use my portfolio tracker, then you'll find it.
Yes, I do use it. I do have that. I got that off you during the week, but I have too many tabs open, so I won't waste time going through it all.
Yeah.
Andrew has asked you, what do you plan to do with your Alibaba holding?
I'm holding. I mean, I never sold it. Yeah, and there was a reason for it. That fundamentally it was doing what I was expecting. No, what my thesis was. But my thesis was also that the share price would double in 3 years. Clearly, it didn't do that. So that thesis failed. Yeah, because it was a growth investment for me. But fundamentally, it kept delivering the cash flows. It started doing buybacks. It even initiated a dividend. So there was never a reason to sell for me, other than the perception on Chinese stocks. But now, I mean, it's insane. They were best, and suddenly all over CNBC, they're saying like, "Oh, China undervalued. You should own it." This whole thing of like, you don't own your shares when you own Alibaba, it has disappeared. I mean, it shows you again like how the narrative can change in the blink of an eye, how subjective this narrative is. Fundamentals were doing what I was expected to do. I will confess, sometimes was really feeling like, am I holding a cat in the bag here with the share price? Because I bought it for the share price, not for dividends. Yeah, it was part of my growth portfolio. But I thought like, well, the only thing that's happening is that the multiple is getting lower and lower and lower, and this company turned the buyback machine on. Like, of course, the Chinese risk here of the government stepping in, but yeah, I just stick to my plan, and will keep sticking to my plan at the moment. Yeah.
Yeah, makes sense. Just to go back on you gave me a chance to look at the portfolio tracker. They are 14% of my dividend income between the two of them, which is quite high. It's really uncomfortably high, but that's what they are. Humberto has asked us about Diageo's recent drop. Results aren't promising, but they have been low for quite a while. Is their dividend still safe?
Well, really simply, they have not been really doing well with debt management and earnings and cash flow over the last few years. So I think it was simply very overvalued all those years. And it's probably now being a bit more reasonable and more reasonable territory.
Yeah, they were always trading at a premium. And the last time we looked, I think it was maybe a quarter ago, it was still overvalued. It still had quite a bit to drop before it even got to my fair value. I think China's impacted them quite a lot. They're looking at spinning off Guinness, I believe, or selling the Guinness brand, which I'd be disappointed in. But I mean, they are struggling. Is the dividend safe? I would say so. I don't expect much growth or any growth when they're struggling, but I can't see them calling it. But who knows? It depends how long they struggle for. Let's see. Question for me from Thomas. What are your favorite investment trusts and why do you hold them or have them on your watch list? There's a lot of infrastructure ones that I like, particularly around solar and wind. So UK wind is one, Nexstar Energy Solar is another. I also like, my favorite one is JP Morgan Income Growth Fund. Now, I think I mentioned this the last time. That is one of my favorite funds because you get income and you get capital appreciation from it, and it gives me access to some of the stocks I will not buy myself. So they are heavily invested in the Mag 7. So if they have a drag, expect the returns to drop. But they are my favorite ones. But mainly, I invest in investment trusts for kind of higher yielding propositions. So UKW, Nexstar Energy Fund is one. There's a couple of infrastructure ones. So that's typically what I like. There is a second part of this question from a different Thomas, and he's asked if I ever looked at Caledonian Investments. I haven't looked at them, but they have been brought up to me before. They have a impressive track record. They would be what's considered a dividend hero in the investment trust world. A 57-year track record of raising dividends. So I haven't looked at them in an awful lot of detail, I have to say. And also wrote down on one of my long lists, so I will get to it. But yeah, I hope that answers the question. Investment trust for me, I'm using for more of a higher yield proposition at the moment, but that may change. As honestly, I find more and more that I like. Looks like a greater percentage of my portfolio is going into investment trust, but at the moment, it's mainly infrastructure and JP Morgan is the ones that I have. Perfect. That is the last question. Thanks a million to everyone for all the questions. We do really appreciate them. And if you haven't already, please like us, give us a rating on Spotify or anywhere. Follow us on Facebook, and we'll see you all next week.
Remember, both of us at Dividend Talk are not certified financial specialists through formal education. We are just two guys sharing our journey for inspiration and entertainment purposes. Hence, this is not investment advice. Although we do our best, we can't promise that the information discussed is always correct, nor appropriate for you or anybody else. We always recommend that you do your own due diligence and be accountable for your own choices. As we always say, you can't borrow conviction from others. Last but not least, by listening to our podcast, you agree to hold us harmless from any ramifications, financial or otherwise, that occur to you as a result of acting on information provided in this podcast.